Welcome back. There's been a lot of talk about Canada's economy, that it's in a fragile situation, growth largely flat, with governments running record deficits. Don Drummond is a senior Canadian economist, fellow in residence at the C.D. Howe Institute. He's at Queen's University. He's a former chief economist at TD Bank. We could use the entire interview time to list different positions and accomplishments you had, but instead I'll just say, welcome. It's good to have you.
Thank you very much.
You spoke in Halifax today on the matter of investment, taxation, and growth in Nova Scotia in particular. The province has a lot of one of those things, taxation. How about the other two?
Well, I must confess, I started out with a particular message that we should all be very concerned as Canadians. We have always been concerned about our weak productivity, and we've had that problem for quite some time. But now we have this second shock of the trade uncertainty with the United States. And a quarter of our economy is exports, and 76% of our merchandise goes to that one economy. And even if Trump wakes up tomorrow and said, I wasn't really serious, I'm not going to do it, that trust has been broken, and companies and people are making an investment decision. So we have to very, very quickly change our model. And this is going to take more than just doing taxes. Tax has to be part of it, but we're going to have to do a lot more than just the taxes. And it's intriguing, in particularly in the context of Nova Scotia, because there was a growth commission in Nova Scotia more than a decade ago, and I recently refreshed my memory of it. And it could be written again today.
The Ivany report.
Exactly the same thing. Yeah. And it said we need to shift away from corporate and personal income taxes towards indirect taxes. We need to lower the corporate tax rate. We need to improve some of the tax credits. And I think, well, all those things stay in today. We need to streamline and reduce regulation. And it really comes back to that context. Why didn't those things happen? Is because no one, particularly politicians, perceived that they needed to do it because life was fine without doing it. And my message was, life is not fine. And this is what upsets me with forecasts like the Bank of Canada, where they assume CUSMA will be renegotiated as is, and it'll be smooth.
Well, that's my next question for you. You've written an opinion piece in the Globe Mail, in which you came right out and said, look, the forecast by the Bank of Canada, too rosy, and you know, based on trade, and you think they're looking at it that CUSMA will be renegotiated. It's a matter of fact that it will happen and things will largely be smooth, and you don't buy that.
They don't word it exactly that way, but the implication is clear. They say that they assume the tariffs stay at their level of January 23rd. Well, that means CUSMA gets renegotiated. That's the only way tariffs remain unchanged. Yeah. And then they say that they assume that trade uncertainty will diminish. Well, that's code for saying the process will be smooth. Who in the world, and Canadian, would think that the process is going to be smooth? We have a volatile outbreak from the president virtually every single day. It's going to be 50% on aircraft today. It's going to be 100% if we do a trade deal with China. You know, there's going to be a tariff on bathroom vanities, and there's not going to be a tariff on bathroom vanities. How does that lead to any assumption this process is going to be smooth?
Yeah. Should the Bank of Canada be looking at lowering rates again?
I think in that uncertainty, they could probably hold off. In fairness to them, the economy, while it is somewhat weak, it hasn't fallen apart. There has been actually some employment gains of late, and we do have a pesky little inflation issue. It's come down an awful lot, but the underlying rate of inflation that they track are still running around 2.5%. Now, I think they will continue to come down and will be okay, but we have to remember levels do matter. Their policy rate's 2.25%. And people who are younger think, well, that's kind of high because it was a lot lower than that. Somebody who's a little bit older looks at the historical record. 2.25 by the base of history is a very low rate. Yeah. Our 10-year bond yield is just over 3%. They have typically been 6 to 8% historically, so those are already pretty low. And then finally, as the governor as I said, there's not much they can do on monetary policy to overcome a structural shock like tariffs.
Some analysts believe that we could still be on the precipice of recession.
See, the recession issue is not even the one I worry about. Because when you go in recession, you go down and you come up fairly quickly. And yes, they're painful and they hurt a lot of people, but 3 or 4 years down the road, you're kind of back where you were before. I worry about a permanent loss of income. If we lose export markets, particularly a lucrative export market like the United States, and we're not able to make that up, our level of income will be lower, not just for 1 or 2 quarters, which would qualify a recession, but for a very long time going forward. And Bank of Canada speak, our potential growth rate will be lower. our permanent unemployment rate would be higher. That's what I worry about, not just the short term.
And obviously that would have an effect on the type of services that Ottawa could offer.
We already have big deficits. We got a debt to GDP ratio that's over 40%. And we just had a parliamentary budget report said today if they satisfy the defense commitment, that's going to add another 6 percentage points. So in the budget, they showed the debt to GDP ratio coming down a little bit. Add in the defense, it wouldn't come down at all. It would go. And as I did a sensitivity analysis, all you have to take is 100 basis points higher interest rates, and it goes up a lot.
Okay, well, Ottawa's got this massive deficit, but we have very big deficits in all three maritime provinces here. Does the public care? Does it, like, the numbers are so big, does it resonate?
Well, and also, to some degree, they've bought the line the federal government keeps touting, we're in better shape than the others. And it's like somebody else being really, really sick, and you're only somewhat sick. You're still sick. Mm-hmm. The United States has got a deep problem, and they're paying a price for that. We have typically had higher interest rates in Canada and the United States. Now our interest rates are lower. Our 10-year bond yield's 100 basis points lower than is the United States. We've seen the steady erosion in the value of the U.S. dollar because they're moving out of U.S.-denominated assets. So we can't look at we're better shape than these other basket cases, therefore we shouldn't worry about it.
I got about 30 seconds here. When looking at deficits, we already hear from young people that they don't even think that they're ever going to get into the housing market. This, obviously, these deficits are going to take, when we do get to the position to start paying them down, it's going to take a very long time, probably on the backs of the next generation. What's the risk in that?
Well, it's patently unfair to young people. So when they graduate from university, they're having a tough time getting permanent good jobs in the labor market right now. They can't afford a house. A starter house in many of the urban centers in Canada are $1 million plus. Even if interest rates are low, they can't afford the debt on that. You look at things like the Canada Pension Plan, their contributions are higher than the value because older people, like me, didn't pay what they should have paid. They paid what they were asked to pay, but it wasn't enough. And it's just a heavy burden on them. We're not passing very much onto them by way of public assets to offset that. And so we're making their life difficult, and it's going to continue to be difficult. That's why we have to cap the debt.
Don Drummond, great to have you in. Lots to think about. Thank you for that.
Thank you.
We'll take a break. We'll be back with much more of your newscast after this.